a few minutes for everyone to jump on. Still got a couple of minutes, so. Couple more minutes. There's a lot of people jumping on.
We'll just give it 1 minute or so. We've got about 50 people registered today.
Well,
appears to be quite a popular one. It's kind of, I guess, a summary of what we've been doing in the past webinars, and it's putting it all into practice. And we're hoping that you'll learn something from this case study that Jack and I have worked with and worked through. And it's one of the Provincia's properties that we purchased how long ago, Jack?
2019.
Yeah,
2019. It was the fifth property in the fund as well.
Yeah,
fifth purchase. One of the best purchases, I think, to date.
yeah, it was a really good buy, and it was one that was kind of discounted by the whole market, and
yeah,
no one wanted to buy it, and we found out that there was some problems, but they were fixed fairly easily.
And that's what we're going to elaborate on today.
Anyway, shall we make a start?
Yeah. So I think everyone's on, so I'll just share the screen and we'll open the slide.
So good afternoon, everyone. Thanks for joining. My name's Carl Burling, and this is Jack Revel. We're the founders of Provincia, and today we're going to talk about one of our properties, 102A Carbine Road, and we're just going to talk about how and why we bought this property, and just take you through the whole process and what we did in the due diligence, and how we really got quite a bargain in what was a really buoyant market.
Yeah.
So as I said, Jack and I were the founders of Provincia. We started the fund 5 years ago, and with one property, and now we're at 13 properties, and just over 100 million value in properties, and every single property was what we call an add value. So we're going to talk about Carbine Road, which is one of them, and we're going to tell you how we added value to that property. So our overall aim of the fund is to create a diversified portfolio, so spreading risk, and of all properties that we buy, we like to see the value added within a short to medium period. So that's why we don't like trophy buildings, because most trophy buildings, you buy them and there's no additional value to add. They're basically set for say 10 years, and you have a tenant paying them there, but what you pay is normally the value, so there's no value added. So yeah, so what we're aiming to do is give long-term competitive income, and more importantly, capital gain to shareholders. So the value of the properties and the value of the shares in the fund will keep up with inflation and do better than inflation. So it's really important that there's no devalue of shares. Anyway, so just a quick roundup about the fund, and then we'll get on to the case study. So we only buy industrial, and industrial has proven to be the best commercial investment in New Zealand by far over the last 15 years. So in terms of income and value, we're looking for value add opportunities. Areas we're investing in areas with sound economics, so with other industry, buoyant economies, local economies, with increasing populations, and our niche value range is between 5 and 10 million. Main reason for that is you get properties that are over 10 million, 10 to 20 to 30 million with a single tenant. It's always very difficult to find a new tenant if that one moves out. So you're looking at vacancy loss. So that's why we're focusing on $5 to $10 million range. So let's get into the case study.
Yep.
So this is Jack.
Yeah. Hi.
We've been in partnership for just over 12 years, and the fund has been running for almost 6 years.
Yeah, this is the 6th year. So
yeah,
5 years. Started in November 2017. That was the first property we acquired, which was Richard Pierce, and it's been really good since then. So today's the case study on. It's actually about the 5th property we bought. So we bought 102A Carbine Road, which is in Mount Wellington. So this is Carbine Road just here, running down the side, and then it's Gabador Place is along here. So this road that runs down the bottom of the screen, that's Gabador Place. So this particular property is actually split over 3 titles. So you've got 102A Carbine Road, which is the bottom factory, top right factory here, and the outlined in red, and the small office in the center of the screen. And then we've got 2 adjoining warehouses, which are actually both on cross lease titles. So that's basically number 1/4 Gabador Place and number 2/4 Gabador Place. So essentially this building is 3 titles. So 2 of them that are cross lease, 1 that's a freehold, and it's split across 3 tenants.
Yeah, so Jack and I had seen this property listed. It went on and off the market, and we wondered why. So we approached a real estate agent that we knew, and he approached the owner. So what we found, the main reason for it not selling was that the both buildings had a very low earthquake rating. So they were below 34% of new building standard. So effectively, no one could lend money on these properties because the bank will not lend on properties that are earthquake challenged. So Jack and I did a bit more investigation. We got our structural engineer onto it, and he found some quite interesting things.
And the other issue that was also on top of it, that a lot of people were mainly put off by the fact that it had low earthquake rating, as Carl's just mentioned, but also the leases weren't that great. So that all the leases were relatively short term when we took it over. So they were all on less than 1 or 2 year leases. So that was the other issues that the building had. So it was a combination of issues on this building, which we uncovered, but we really liked it because we found it had some great potential. So this is inside one of the warehouses. This is inside the warehouse at the back of 2/4 Gabador Place. So it's the rear warehouse at the back adjoining Gabador Place. And you'll see it's a really, really good tenant. It's actually an engine rewinding company. And when we were looking at getting under contract, this particular tenancy had less than 2 years to run on the lease. So that's quite short-term tenant in the premises, which, it would be off-putting to some investors. So we had discussions with them during the initial due diligence, and they indicated that they did want to renew the lease and they did want to stay on long term, and they'd been in the site for approximately 10 years. So they're well ingrained in the site. They didn't want to leave. So it was that option that presented itself that we could actually have that ability to renegotiate the lease. So that was a real positive.
Yeah. So basically this building had 2 problems. One was the earthquake rating, and the other was the short-term leases.
Yeah.
So a lot of investors would just walk away, but Jack and I saw that as a really good opportunity. So we got the building under contract, and we went through and started our due diligence process.
Yeah. So what we found is the earthquake ratings on both buildings were very low. I think they were below 37%. From memory. So that's what off-puts a lot of investors, because that's alarm bells to banks. They require any buildings to be above 67. So this actually fell into the D class rating because it's below 37. So we had that issue. But what we wanted to know, or what part of the due diligence is, okay, it's 37, but what's actually involved in bringing the building up to a acceptable standard?
So with earthquake strengthening, it can be a major job. So you can end up having to spend millions to upgrade the building, or it can be something quite minor, something that the previous owners forgotten to do or haven't done, or they haven't done it properly through the council consents. So in this case, we found that the problems were relatively minor and inexpensive to fix. So that was great.
Yeah, really good. So and the other aspect, so during the due diligence, what we were looking for is we got our engineer to assess this. So we got it under contract. We had pricing from the actual vendor that was presented to us based on the IEP that they had done. So that was another weakness in the market, is they were handing over their IEP, initial earthquake procedure, showing that it was 37%. And that company had estimated cost to be north of about, I think it was 200 to 300,000 to do the work. So that, and that's substantial cost. So that was the first issue. But what we did is we got our own engineering report done and assessment done. And what we found was that in the walls on this building, so what they did is they actually got the machine out to X-ray the building, to X-ray the walls. It's quite cool to see if there's steel rebar in, because the drawings that they had been presented to the original earthquake engineer for the vendors and on the council file, they had no indication if there was actually steel rebar running through the walls.
So the top building there had a rating of, I think it was 34% of the building standard. And the main reason was because the engineer that they engaged said that the walls were not reinforced. So it was basically concrete with no steel reinforcing. So that, and that was also on the council file, which was really odd. So Jack and I got our engineer there, and of course he used his X-ray vision.
Yeah.
and he said, just quietly to us, he said, do you guys realize that all this building is actually reinforced, steel reinforcing? So we kept really quiet about that. And so to upgrade that building was basically an inspection by our engineer in about an hour's time.
Yeah.
So it was, $500 to upgrade a big warehouse from 34% to way above 67% of new building standard. So that top building was an easy one.
Yeah, and that's why it pays to check and do your own homework and your own research with trusted engineers that you like to work with, because that saved us a huge cost, and that was something that would have been off-putting to a lot of other investors. And then on the other building, which is where Gavador Place is, inside here, the works that only need to be done were actually quite different from what had been originally quoted. So the plan was there was no steel support lintel inside a wall that had been cut through, so that the original tenants had actually cut through this wall, or original landlords, had cut through this concrete block wall, but there was no steel lintel support to secure that building, and there was also no cross bracing in the roof, so that made the building very unstable. But it was quite easy to basically rectify this. The total cost for all of the design work, steel work, engineering, doing the labor and getting this signed off, the total project cost was only $80,000 to do this. So down from a quoted price of north of 200 to 300 down to 80 to the whole project. So that was just adding in this additional cross bracing into the roof space, and then also lining the steel with this doorway with a lintel, which is a steel support lintel here.
So the key to looking at buildings like this is that you do all the work, all your due diligence during a due diligence period. So you're still conditional on the sale, but you're doing all this pre-work. You're working with the tenants.
Yep.
You're firming up leases. You're looking at the structure of the building, and it's amazing what you can find in terms of buying something for a good price, because it's perceived to be in not very good condition and not a good investment.
Yeah. Exactly. And so this is in combination with finding this out, making sure we've got the plan in place to do the work. during the due diligence, also making sure this particular tenant here was committed for long term. So we're doing all this work before we got the valuation carried out. But also, I'll just skip back to the overall photo. There's this yard area at the back in Gabador wasn't actually rentalised on part of the lease as well. So that particular tenant, Connect 8, we talked to them, that tenant at the time, they were going to leave, but that's actually an upside for us because we knew we could get another tenant in that space. It's a really good location being Mount Wellington. And we also knew that whole yard space outside of it hadn't been rentalised in the included rental area. So we knew when they leave, we'd actually be able to get a higher rental because we can actually include that additional yard space, which wasn't taken into account in that original lease. So that's something else we picked up in the due diligence. So this tenant we basically knew was going to renew the lease. The tenant at the front, they were tied in on very low, they had right to renewal all the way through of 2 + 2 + 2 + 2, which they still have, but they're very much under rented because that particular lease was tied in on CPI. So we knew we're going to get upside there one day in that particular tenant because the rent's very under rented for what market rent is in Mount Wellington. However, there wasn't an option. We knew they were secured in the building. They're on low rent, but it's indexed to CPI. So that was all right. We made sure this particular tenant who took up majority of the space at 1 bar 4 Gabador, 1 bar 4, the front unit, was going to stay. So that was really good because we had that option to renegotiate the lease with them. And we knew the middle tenant was going to leave, but we knew we could rentalise that yard space, which would increase the rental.
So the initial value add was doing the strengthening and therefore getting it for a good price because it was overlooked by the market. And the second thing was strengthening the leases on 2 of the tenancies, which we could do straight away. And the third thing was a bit, probably about one year down the track.
Yeah,
We renewed the other tenant, and also they've got what they call CPI index rent reviews. So that also came up. So that was the second big increase in rent and value.
Yeah, so the initial purchase price, we had it under contract, was so we bought it in the end for 7.1. When we were negotiating, we went in lower than that, and the vendor wanted substantially higher. So we played that game going back and forth a few times. Then we got it discounted even further because of the cost with the earthquake strengthening that was sent to us from the vendor. So we actually discounted the price further because of their quote, even though the quote was actually a lot cheaper. So we ended up buying it for 7.1 million. So that was the initial purchase price, 7.1. It cost us 80,000 to do the work, for the strengthening work. And the initial valuation based on these areas that could be captured and was 7.93. So that's a registered valuation. So that's an $830,000 jump just from finding space that we could rentalise in the future and also getting that buildings up to an acceptable earthquake standard. So just from doing that, it can jump. That's 830,000 that we added to the value to the property. That was the initial. So 7.93 was the initial valuation. Later on, so as Carl just mentioned, we actually were able to secure these tenants and renegotiate them on much longer leases. So this particular tenant here, Gook and Sullivan, they do the engine rewinding, really good tenant. They're the ones who have been here for a long time. We managed to renegotiate that lease and get them on a brand new 6-year lease. So they wanted to be there long term rather than having their 2 years to run on the current lease. They entered into a brand new 6-year lease and they're really happy in the building. So that also provided a lot of upside, and we're able to sort out that other tenant who was occupying the middle warehouse who left. We got another tenant in there really quick before the other tenant had even left. So it was the leases where there was no vacancy loss. We were able to capture and rentalise that yard area. So that really increased the rent. So this has all happened after we bought it. And so that was really good. So that provides increased return to the investors, and then also in terms of cash flow, because we're getting a much higher rental for that space, and we're also able to increase the value. So now the current valuation on this, which was from last year, March 2022, was 11 million. So basically we bought this in the 2019 financial year for 7.1. Initial valuation 7.93. So that's what we did at first. During the 2019 to 2022, we're able to renegotiate this particular lease and get a new tenant in the other premises. and the value has increased to 11 million. So that's a substantial increase, which is all passed on to our investors as part of the fund. So
So I'll just make a quick summary. So this is we're explaining this property. It's what we call a workhorse, and that's why the type of properties we like, and we don't like trophy buildings. And so because with trophy buildings you can't add a lot of value. And this is also an example of why we like earthquake challenge buildings, and also buildings with short leases, because there's just really good opportunities to strengthen the leases and add value, and also strengthen the buildings and add value. So if you're looking for yourself, they're good opportunities.
yeah, thank you. So we'll start with, before we get into the frequently asked question Q&As with yourselves. Well, there's just one frequently asked question we get quite a lot, and that is, how is Provincia's share price being calculated? So the answer to that is, here we go.
Yeah, so it's really every year, about this time of the year, around the end of March, 31st of March, which is the end of our financial year, we value all the properties. So we get fresh valuations, and from that we can calculate the share price, and it's a really, really simple calculation, and it's not based on the share market. It's because it's a private fund and we're unlisted, so it's just assets minus the liabilities and divided by the number of shares issued. And so it's a really transparent process, and yeah, so that's what we have done every year, and it's audited. So each year, after our financial audit, we let shareholders know what the new value is of their holding of their shares.
And that's where we can capture all these add value items that we've done throughout the year, such as the year, when we've done this on Carbine as an example, all that new uplift in share value and return. Well, the return's immediately passed on to the investors based on the quarterly return. So once we get that new rent, that's paid out to investors as a dividend. But then when we can really capture that share price is these year-end 31st March valuations, which is really good. And here's a summary of how it's been, how the performance has been since we set up back in November 2017.
Yeah, so this is all about adding value. The market has also done a bit of work for us. There has been market price increases, but through having value add for every single property we buy, we ensure that if the market is going down or sideways, we're still able to add value to the portfolio, and therefore we're able to increase the share price over time. And yeah, so we started the fund in November 17, and the initial shares that were issued were $1. March 31, 2022, they're up to $1.56.
Yeah,
and we're expecting an increase in value this financial year as well, in a so-called down market. So the value add philosophy is working, and it keeps us busy, doesn't it, Jeff?
Yeah, absolutely. But it's exactly what we look for whenever we're acquiring a new property for the fund. So every property we basically have in the fund has a story, just like what we've shown you in Carbine, that's an angle to either unlock value during DD, so at the time of purchase to get that initial upside, or in the medium term. So in the medium term, so after we've bought, we know it's either under rented or has some rent reviews coming up, or a lease ending that we know we can renegotiate and really extract that value from the particular property.
Yeah, so if you invest in a fund, your return is based on the dividend you receive and also the value of your shares. So this is a bit of a snapshot from 2019 to 2022 of how we performed. So the yellow line is the total return. So what that is it's the sum of the pre-tax cash yield plus the fair value gain in the shares, which is basically the increase in the value of the shares, and you add those two together, and that's your total return each year. So and I think we averaged about 15%. Was that right, Jeff?
Yep.
over these 4 years. So
Yeah.
15% total return. So that's the sum of your yield or your dividend plus the increase in the share price. So yeah, so the grey line there is the dividend, and the blue line is the increase in value or the capital appreciation of the share.
Cool. All right, I'll stop sharing this, and what we'll do is we'll open it up so that if anyone has any questions on value add or this particular example or any other questions for us, feel free to type in the chat bar or unmute your mics and ask us direct. Either way, it's great. I think there's one in the chat bar now. Oh no, it's perfect. So yeah, feel free to ask any questions you might have. So here's one just come in. So Carbine Road had about a 12% value add. Would this be your typical? Would this be typical for your projects? So that's a really good. So this one's a really good uplift from day one. Probably most of our projects wouldn't have such a big uplift from the initial from day one once when we purchase it, but in the medium term. Probably, yeah, some of them definitely have had about a level of that increase, if not more. We've got other examples like Arwen Place. I know that's one we've been talking about. That's had a substantial increase. So we bought that back in 2018 for 6.1, and it was like the rents have substantially grown, and now we have this opportunity whereby we can actually renegotiate the lease with the existing tenant. And we've currently got an advisory report sitting around the north of the $10 million mark. So that's a 6.1 purchase back in 2018, but and throughout the years we've been able to have rental growth on it. It has been going up in value, but now we're able to actually renegotiate that entire lease, and we're going to be north of the $10 million mark on that one. So that's another example of a substantial increase in value.
So we like to think within a very short time we'd get plus over 10% increase in value. Or on basically purchase.
Yeah, that's correct.
Is our rule of thumb. Yeah. And then after that, anything after that is a bonus.
Yeah.
Just got another question here from Daniel. Are the total number of shares limited in number, or is the quantity increased over time? That's a really good question. Yeah. So if the fund was to be a static fund and we're not adding any further properties, if we issued more shares, that means dilution of the income. So that's something that we wouldn't do. So the only time that we can issue more shares is when we buy the property. So we're backing up the issue of new shares with further income and value. So yeah, I hope that answers your question. So it's only limited when the portfolio is static. So when we buy another property, we issue more shares to raise more equity, and we get more bank funding to buy the new property.
Awesome.
Thanks, Carl. That answered the question.
Any other questions for us?
Yeah, I think you've really presented it and covered it really well. So I don't have any other questions.
Thank you. So any investors can do this themselves as well based on properties. So that's what we're trying to give you an understanding from this webinar series. From the get-go, we've been talking about the different properties, the lease aspects, the value add, the finance, the management, tricks, stuff to do with the cap rates, and then into putting it together like what we've done in this example of a case study. So we can do it on smaller properties. Investors can do it themselves with their own properties as well. We've seen it quite a lot.
Yeah.
So yeah.
And if you want to catch up on any of the past webinars, just visit the website. They're all up there now. And we also have a YouTube channel now, don't we? Yep. So you can watch them on either of those platforms. We are open for investment. Provincia is open at the moment. So if you're interested, just give me and Jack a call or request an investment statement. I forgot to say that Provincia is only for wholesale investors. So you have to qualify as wholesale, which is basically you need to understand the investment and you need to fit into the wholesale investor criteria. So thank you all.
Yeah, thank you.
We'll look forward to hopefully seeing you all next week.
Yep. So next week, same time, 12:30 next Thursday. And we'll be talking about basically wrapping up Provincia in a nutshell, explaining how the whole concept works, how the whole fund works, and how the whole structure works, and what the returns have been. So it's going into a bit of more detail about the whole structure, wrapping everything that we've done up. Awesome. Thanks, everyone.
Okay. Good afternoon.
Thanks. Bye.
Bye.